Morning, everyone. On behalf of Go Fashion India Limited, we thank you for taking out the time and joining us today. We welcome you to the virtual brokers and analysts meet on the announcement of the company's forthcoming IPO. Before we begin, I would like to introduce the management and other distinguished guests who would be addressing today's gathering. From the company, we have with us Mr. Gautam Sarauki, Executive Director and CEO, and representing the BRLMs, we have Mr. Kamraj Singh Negi, Managing Director, Investment Banking at DAM Capital Advisors Limited, Mr. Saurabh Jain, Vice President, Consumer and Retail Sector Coverage at ICICI Securities Limited, and Ms. Kriti Goyal, Vice President, Capital Markets Group at JM Financial Limited. We have placed all microphones on mute. Post the presentation, we will welcome questions. A sincere request to all to kindly type your respective questions in the Q&A panel available to you, which will be read out to the management on completion of the presentation. A gentle reminder to kindly post your organization name along with your name while posting questions. I would now like to invite Mr. Kamraj Singh Negi from DAM Capital Advisors Limited to initiate the proceedings. Over to you, sir.
Thank you, Nikhil. Good afternoon, ladies and gentlemen. On behalf of DAM Capital Advisors Limited, I welcome you all to the virtual brokers conference of Go Fashion India Limited IPO. I hope you all are doing well and keeping safe. We at DAM Capital feel extremely privileged and honored to be associated with Go Fashion India Limited. I'll not take much time explaining the company to you, but given the journey that Go Fashion team has gone through, it is worth mentioning that Go Fashion is a women's bottom-wear brand in India with a market share of approximately 8% of the branded women's bottom-wear market in fiscal 2020. They are engaged in the development, design, sourcing, marketing, and retailing a range of women's bottom-wear products under the brand Go Colors. They are among the few apparel companies in India to have identified the market opportunity in women's bottom-wear and have acted as a category creator for bottom-wear. They were the first company to launch a brand exclusively dedicated to women's bottom-wear category and leveraged this advantage to create a direct-to-consumer brand with a diversified and differentiated product portfolio of premium quality products at competitive prices. They offer one of the widest portfolios of bottom-wear products among women's apparel retailers in India in terms of colors and styles. As of September 30th, 2021, they sold bottom-wear in over 50 styles in more than 120 colors. They serve their customers primarily through an extensive network of 459 exclusive brand outlets that are spread across 23 states and union territories in India as of September 30th, 2021. The large format stores have grown from 925 as on FY19 to 1270 as on September 30th, 2021. About the IPO, this IPO is a combination of fresh issuance of INR 125 crore and offer for sale of approximately 1.3 crore shares. Price band is INR 655 to INR 690. Total issue size will be INR 1014 crores at upper end of the price band. Issue opens to public on Wednesday, November 17, 2021 and closes on Monday, November 20, 2021. We have received strong interest from market domestic as well as foreign investors, which is a testimony of how investors acknowledge the journey of this company. I'll now hand it over to the moderator, and thereafter the management team will take you through the business presentation.
Good evening, everyone. Thank you for coming for this meet. I'll start with the journey of the company, and then I'll continue with the presentation explaining about how the business has grown and so on. So we in 2010 2011 is when we had started this this company. It was when our family background was into in the garment export business, which that business ran for almost more than 2 decades. It was around 2010 2011 we wanted to venture into the retail space, and because we were from a garment export background, we wanted to do something in garment retail. So in garment retail, we were exploring which is a good category to take where there is less competition. So we wanted to basically enter a white space. It was during that window of time, we saw that there is a transition from the women's sari market to the two-piece separate market. In the two-piece separate market, the top and the bottom being two different pieces of attire, the bottom was of a significant relevance. And what we noticed as a company was that there were not too many organized players in the bottom wear space. That is how we picked up on this product and we started Go Fashion India Limited in 2010. Initially in the journey of Go Colors, we started with a couple of products. We started with the chudidars and leggings, and we were more of a legging brand. But as the years went by, over the period of 4, 5, 6 years, we kept adding new product after product after product. And we made a portfolio of about 50 products and more than 120 colors. And now we have evolved ourselves into a complete ladies bottom wear brand. Initially, when we wanted to start selling, we sold through kiosks. So we opened our first kiosk in 2011. The reason we went to a kiosk was because at that point of time, we had only 2 products, like I mentioned. When we opened our first kiosk in 2011, it did fabulous numbers. I think it was overwhelming and it was much better than what we expected. So not only did we start with that kiosk, we opened up to 80 kiosks over a period of 3 to 4 years. By 2014, we had about 80 kiosks. But as we kept adding product after product, the kiosk became unsustainable as from a size perspective and lack of trial room perspective. So we took an experiment and we started with our first store in Chennai in a store format. That store format did extremely good in terms of response. It did even far better than the kiosk. Then as management, we knew that the store model is the right model for us to move forward. So not only did we start to transition our kiosk to stores, but starting our first store in 2014, we went up to open our 400th store by 2020. In this long journey of 10 years, where we've added 400 stores, we added 50 products, we've raised capital twice. We had raised about 60 crores from Sequoia Capital in 2014, and we had raised about 100 crores from ICICI Venture in 2018. Now, talking a little bit about the category. Now, what we have tried doing in Go Colors, I'll explain. See, in Go Colors, we have positioned ourselves as a one-stop destination for women's bottom wear. When a lady thinks about bottom wear, she should think about Go Colors, irrespective of the category. What I mean by irrespective of the category, bottom wear is a universal category. We at Go Colors are not limiting ourselves only to ethnic products or Western products. Our bottom wear consists of ethnic bottoms, it consists of Western bottoms, it consists of fusion bottoms, it consists of athleisure bottoms. Today, we are a one-stop destination. So irrespective where the customer is picking her top from, she might buy her top garment from any ethnic brand or Western brand or fusion brand. She can find the relevant bottom at our store. And that is what we have positioned ourselves as a one-stop destination for women's bottom wear. This category is primarily core and essential in nature. Though we are sold with fashion, because top wear is fashion, but we are core in nature, and I'll explain why. In India, if you see the 2 pieces of attire of a lady, the top is usually the fashion element. When the top is fashion, the bottom automatically becomes core by default. And thus, this is a functional and a day-to-day product. This category, another good highlight about this bottom wear category is it's a horizontal category. Now, what I mean by horizontal category, if you see the bottom left or right of the screen, the number of variants we can have in bottom wear compared to the other categories. This product extension capability, what we have within bottom wear, shows the lot of scope we have in future edition of products. Now, how big is this market? Though this is a niche category, this is an extremely big market. So I'll give you an example. Today, if you see on the screen, this is a research report. As on fiscal year 2020, the entire women's bottom wear market was about 13,500 crores. It's growing at a growth rate of 12%, and it's soon going to touch 24,000 crores by 2025. The important factor here is that Go Colors is playing in the branded segment. Out of the 13,000 crores, about 33% is branded, which is about 4,000 odd crores. In this 4,000 odd crores, we have a market share of about 8%. Now, there is a very big organic shift happening from unorganized to organized, from unbranded to branded. Not only do we have an opportunity to grow this 8% market share, but our addressable market of 4,000 crores, because of the shift from unorganized to organized, is going to grow at 20% and become 11,000 crores by 2025. This shows, because of this shift and being a niche category, there is a long runway for growth. Now, like I was explaining in the first slide, we started off with 2 products and we built a product portfolio of about 50 products. As you can see, we have good number of products in ethnic, in Western, in fusion, in athleisure, in lounge. This variety of categories what we're dealing with makes us a one-stop destination. Our average selling price is about 619 rupees. This average selling price, we would want to keep it at the right pricing strategy, because we want to reach out to full India. We want to reach out to all India, all customers across all tier towns. So pricing is going to be a very, very important aspect in our business. Now, just to talk a little bit about the sales and distribution of the business. So what we have done here at Go Colors is we have tried building a direct to consumer brand where we are selling to our final customer directly. And EBO and online gives us that strong footholding of becoming a direct to consumer brand. So today, about 69%, as on fiscal year 21, 69% of our sales are coming from our own stores across the country. We have about 459 stores across 118 cities. Today, about 22% as on fiscal year 20, our sales came from large format stores like Reliance, Central, Unlimited, Globus, Spencer. About 5% comes from the online world and about 5% comes from the traditional retail market. Now, what we are trying to do is we want to build a direct to consumer business where we are able to scale the EBO channel and the online and the LFS channel. Now, talking about our EBOs, where we have located our EBOs, how we have located our EBOs. EBOs being 2/3 of the business, I'll just explain some metrics. We follow a cluster-based expansion model as far as EBO additions are concerned. So though we have spread across 118 cities, if you see 60% of our total EBOs comes from the top 8 cities. So what that means is, rather than spreading ourselves thin in the country, we open more number of stores in a single geography so that there is better brand recall and visibility to customers. So for example, in Mumbai, we have more than 50 stores. In Bangalore, we have more than 40 stores. In Chennai, we have more than 35 stores. So rather than spreading ourselves thin, we go deep. We have grown our EBO network at a CAGR of more than 30%. Our average store size is somewhere between, usually signed between 300 and 500 square feet. Our average size being around 380 to 385 square feet is the size of store we usually take in prominent high street malls and airports. Now, talking a little bit about the strong unit economics of the business. Because EBO is 2/3 of the business, I'll a little bit focus on the EBOs. Now, for an EBO to be successful in India, there are 3 very important parameters and pillars. The first most important parameter and pillar are gross margins. The second most important parameter is sales per square feet. The third parameter is same store sales growth. So let me talk about the first important parameter. Our gross margins are very, very healthy at a company level. We are having company level gross margins about 60%. Now, the reason we have been able to have very high gross margin in such a niche category where the pricing is the right pricing is because of our full price selling strategy. Because our category is core and it is functional in nature, we are able to sell more than 97% of our sales on full price. And that is the reason we are having very, very strong gross margins in our business. The second important parameter is sales per square feet. Now, one of the reasons we have been able to have such high sales per square feet in the industry is because of our efficient use of real estate space. Today, we are stocking the highest number of units we are stocking one of the highest units of inventory per square feet in the retail industry. This efficient use of real estate space is translating into very high sales per square feet. The third important factor is same store sales growth. So we have delivered very, very healthy same store sales growth in fiscal year 19 and fiscal year 20, which is also reflecting at a volume level. One of the tailwinds we have for same store sales growth is the shift what we are having from unorganized to organized, from unbranded to branded. This strong tailwind is what we have in the category has been keeping the same store sales growth very positive, and even the next few years to come, it's going to be very positive. Now, our EBO is a very, very profitable model. But having said that, today our LFS channel, our online channel, and even our traditional retail channel, all four channels are very, very, very profitable, are equally profitable, and we are able to generate a 30% EBITDA at a channel level across all these channels. So these are our colorful looking stores across the country. So if you see on the four blocks, which is on the left of the screen, and the four blocks on the right of the screen, the four blocks on the left reflects to our stores what we have across high streets, malls, and airports. On the right of the screen is our placement in larger format stores. The one thing you will see across all Go colors is the consistency in look, feel, design. Right from our first store to our 459 store, the consistency of look, feel, and quality is standardized everywhere. This is because of our strong execution. So now talking about the advertising, the one asset we have, where the advertising medium cannot be quantified, is our stores. The kind of mileage and advertising mileage our stores add in the offline world is unbelievable. It is an advertising which we cannot quantify. Any customer who's heard of Go Colors would have seen any of our stores, whether it is at a shopping mall, whether it is at an airport, whether it is in a high street, a premium location. We are there everywhere. Today, apart from offline advertising, which is done through our stores, we are doing a lot of digital advertising. We feel a lot of advertising has moved to the digital world where we need to create a brand. Today, we are spending about 2 to 3% of our advertising spends, 2 to 3% of revenue we spend on advertising, which is predominantly spent on digital. We feel doing through social media influences is going to dramatically increase the brand equity of the company. Now, talking a little bit of the supply chain, as you very rightly think that today the retail business is an inventory management balance sheet business, which is a very, very important aspect. Today, our entire backend supply chain, we have automated and integrated in our ERP, and we have enabled the data analytics tools in our ERP, which controls the entire supply chain of our backend. For example, today our ERP is able to tell us how much to stock in what quantity, in what ratios per SKU in a store. Today, that is why we have been able to use our real estate space efficiently, is because the entire supply chain is designed by our internal backend. We have our entire manufacturing is outsourced. Today, we as a retail brand, we believe that we do not want to have in-house manufacturing. As a retail brand, we need to have the flexibility of going to the best supplier who's giving us the best and the most competitive rate. And that's why we feel outsourcing manufacturing is going to be a very, very critical aspect. We follow a centralized warehouse perspective, where our one central hub warehouse is able to distribute goods across the country, across all our stores and points of sale, irrespective of the geography. The way we have made a supply chain is that there is no dependency on a zonal warehouse, but everything is taken care from a centralized warehouse. So, talking through some numbers, our company has done very well as far as financials and concerned and performance is concerned. The channel level profitability has helped us give us strong financial results. As you can see, our revenue has grown at a CAGR of more than 30%. Our PAT margins have grown at a CAGR. Pre-pandemic, it has grown at a CAGR of more than 50%. Today, our cash flow from operations is very strong because we are a direct-to-consumer business. We have been able to display very strong cash flow from operations. Our gross margins are very, very healthy. As our company EBO sales increases, the gross margins will further improve. We have very, very healthy, strong EBITDA margins, and our ROE and ROCE are above 18%, which is a very, very good, healthy return metrics in our business. Now, talking about the 4 large strategies, what is going to be there as far as moving forward is concerned. We are keeping it very simple. 1, we will continue to add the number of stores we want. Second strategy is to grow our online sales. Third, stick to bottom wear, keeping razor sharp focused on bottom wear and keep adding new and new products in bottom wear. And using the fourth strategy, using technology to improve our back-end supply chain for better efficiencies. Now, what is going to be our EBO strategy? As I had mentioned, that we follow a cluster-based expansion model where 60% of our EBOs are located in the top 8 cities. Today, there are so many cities we haven't gone to. Today, there is a huge scope of adding more number of stores in tier 2, tier 3, tier 4, tier 5. Because of our right pricing strategy, we are able to go down as deep in the country as possible. Our expansion is not only going to come from tier 2, tier 3, tier 4, but even in the tier 1 and metro cities. As the size of the city is expanding, we are going to see a lot of potential and adding more number of stores in our existing market. Retail, which is online, is a very, very important, significant channel post-pandemic. Today, we realize the importance of this. Today, our online sales have grown from 1% to 5%. But now what we are doing as a company, online strategy works for every company differently. In our space, the online strategy works very well with Omni. Omni-channel strategy is an integration between your offline stores and your online. So what now we are trying to do is, we are trying to make an online experience for a customer where if a customer is shopping on our website, she is able to get last mile delivery from our closest store. So that if she places an order, she can get her delivery within 2 to 3 hours. Similarly, if a customer is coming to our store and not able to find what she wants, we convert that customer into an online customer. This omni-channel strategy, what we are taking, is going to grow our sales, online sales, which is at 5%. It's going to grow multi-folds in the coming future. Now, the third important aspect is bottom wear and leverage our position in bottom wear. See, as a company, our strategy has always gone to be going deep, going in depth. Even in our EBO expansion strategy, we have always gone in depth and opened more number of stores in one geography. Like that, even in bottom wear, our entire focus is going to be on bottom wear. We feel this is a huge category, and we are just going to keep adding more and more products and strengthen our leadership here. Since our business is a very, very complicated supply chain business, we are going to increase the efficiencies through our backend technology and improve our supply chain efficiencies in the years to come to support this growth. Thank you, everyone. This was a short presentation from my side. I'm happy to answer any questions. Thank you.
Thank you so much, sir. We'll now move into the Q&A session. While we have already received some questions and we'll be taking those questions first, a gentle reminder to all to kindly post your respective questions in the Q&A panel available to you. Coming to the first question, so we see that the Go Color stores have always chosen an area with high visibility and high footfall areas. How do you choose the right location?
Sure. So, sir, see, we always have a belief of opening in prime locations. See, I in my starting part of my career, in my first 5 years in Go Colors, I studied a lot of locations. I did a lot of study on ground, and I realized it's always better to pay slightly higher rent, but go to a prime location where the customer is. With the years of experience on ground, we've been able to understand which are the right locations for us as far as high streets and malls are concerned, airports are concerned, and we have been able to strategically select locations. In fact, our business development team, we are on the ground always studying every location and see what works very well for us. The advantages of taking a high footfall area is because your perception of a brand as a brand in front of the customer, if your location is good, increases multifolds. The customer sees you as a very high quality brand. Today's selection of the right location is everything. In retail, we believe the three important aspects of retail is location, location, location. So this is of fundamental importance what we select.
Thank you so much, sir. Sir, do you plan to enter the company-owned franchise-operated model or the franchise-owned franchise-operated models? So, sir, we have a few of franchisee stores, about 10 to 11 franchisee stores, which are in some parts of the country. Our primary strategy is going to be company-owned, company-operated. Some areas or some regions in the country where we feel management control might be a challenge,
In those particular pockets, we might franchise, but primarily, we are going to be a company-owned, company-operated model. And the reason behind this is because we follow a cluster-based expansion model, it gives us better management control of the outlets. So in very rare and few cases, we might franchise.
Thank you, sir. So, what was the capex for the existing 450 EBOs and the capex for the current IPO plan of opening an additional 120 EBOs? And is there any change in the operating format planned for these new stores?
Sure, sir. I'll be happy to answer. So, the capex what we are investing to open a Go Color store is very, very attractive because of our strong unit economics. So we have planned to raise about 125 crores as primary, which is going to be going towards opening, which is going to be a combination of 120 stores, working capital, and general corporate purposes. So we are planning to open about 120 stores, and the capex for the 120 stores would be about 21 to 22 crores, and the deposit would be about 6 crores, which we feel also moving forward, our cash flow from operations are so good that we will be able to maintain our future expansion through internal accruals.
Thank you, sir. So, could you throw some light on the gross margins in the online business as well?
So, sir, see, our gross margins are very, very similar in direct to consumer. So we have very, very strong gross margins in the EBO channel. We have similar type of strong gross margins even in the online channel. So in the EBO channel, we are having gross margins of around 68%, and we have similar direct to consumer margins even in the online world because we are selling direct to consumer. So the gross margins in the direct to consumer business is very, very strong. So as our sales through the EBO and online keep improving, our company gross margins, which are at around 60%, also will keep improving.
Thank you, sir. So, could you also throw some light on who would you consider as your direct peers in the listed space, and how would you differentiate yourself from these peers?
So, sir, see, we are in a very niche category. Today, we have at Go Colors identified a niche space and done really well by introducing many products. There are many good names outside in the women's world who are doing very well. TCNS in the listed space is doing really well. They are a very good company and they're doing very well in the top wear segment. In the bottom wear segment, Go Colors is doing pretty well. There are some other and few name brands as well. So we see this as a very big opportunity to grow in the coming future. As I had mentioned that there is a very big shift from unorganized to organized. We have been growing at a CAGR of more than 30% pre-pandemic, and we are going to be seeing the same rate of growth even in the years to come.
Thank you, sir. Sir, could you also explain in detail the new product strategy into expanding into loungewear and athleisure, and what kind
Sure.
of revenue mix do you expect in 3 years between the WBW and the new segments?
So, sir, see, we are obviously introducing newer products. Like I mentioned, we are going to continue to add new bottom wear products in the overall umbrella of ladies bottom wear. Today, we have introduced loungewear and athleisure. These are young and new categories for us. We have seen post-pandemic, the demand of such categories have gone up dramatically. So we have started introducing new products in this particular category, but it's still fairly young and new. It will in time we will know how much this grows, but these are very prospective categories.
And so, talking about expansion, do you have any plans on carrying out any vertical expansion to top wear and kids wears?
So, sir, see, we as a company have seen that in ladies bottom wear, the opportunity is very big. For me, we as a company at Go Fashion, we don't want to really digress and look outside bottom wear. In fact, in the last 10 years of the journey, we have been razor sharp focused on this. Even in the next phase of our journey, we feel this category, we want to do this one category and make it really big. So our idea right now is to just stick to this ladies category and be in this niche space.
Thank you so much, sir. So, coming to the next question, can we please have the mix of the company-owned and franchise EBO stores? Also, would you be funding all growth through internal accruals, or would you be taking on any leverage?
So, sir, see, our right now more than 99% of our stores are company owned. So today, out of the 459, about 10 to 11 stores would be franchise, and the balance 440 plus would be all company owned and company operated. See, we predominantly want to do a COCO model because of our cluster based expansion model, because of our management control, and we feel this better management control keeps a consistency across all our EBOs across the country really well. Now, sorry, what was your second part of the question?
Would you be funding all growth through internal accruals, or you would be taking any leverage on that?
No. So currently, sir, we have currently our cash flow from operations is very healthy. The funding what we are looking for the additional stores is going to be about 21 to 28 crores a year. Our cash flow from operations is going to be much more than that. So it will be very easy for us to, from internal accruals, to fund this. So we don't really see the need of taking debt in the future.
Thank you so much, sir. So coming to the next question, given your focus has primarily been on being a direct-to-consumer brand, would you be reducing the store network and focusing more on online sales once the brand has gained some more visibility? And would you be investing more in sales promotions going ahead?
So when you mean sales promotion, you mean advertising?
Yeah, we're talking about an entire overall sales promotion expense for overall brand building.
Okay. So sir, see, the way online works for our category is online is very, very dependent on offline. So this online and offline integration, what we are talking about, because apparel is a touch and feel product, so omni-channel is the right strategy for it. We feel our physical store count will not reduce. In fact, the more number of physical stores we are going to be putting in the future is actually going to drive the online sales more. See, today we are going to be giving the flexibility of the customer to buy online, but come to the store and try the product and select the product. Where we are giving the flexibility to the customer saying that, okay, you come to the store, you're not able to find what you want. We are able to convert you into an online customer. So this entire marriage, so the more we grow our EBO network, our online sales are actually just going to keep increasing.
Thank you. And so are your high 30% plus Ebitdas and high ROCs sustainable according to you?
Yes, very much, sir. Because one of the reasons, see, all Ebitda comes down to how much are your gross margins. The one good thing in our business is because we are core, we are a utility product, we are a functional product, we are having full price selling to the max. So for example, more than 95% of our sales are coming from full price. Because of this full pricing strategy, we will be able to maintain our gross margins, Ebitda margins, and PAT margins very well in the near future.
Thank you, sir. So could you also throw some light on the design and sourcing strengths, and also give certain details on how you identify the latest fashion trends?
Sure, sir. So, sir, we have a very strong design team of 10 to 12 members. We have a design head. All these people are they're studying what the market trends are. They're traveling, they're seeing what other brands are doing. They're attending fairs, they're seeing what internationally things are happening. And a lot of product development happens, majority of our product development happens in-house for us. Once the product development happens, we introduce those small quantities in our points of sales across the country. Once the sales keep increasing, that product goes through the maturity cycle. Like I gave you an example of loungewear and athleisure, right? So we've introduced loungewear and athleisure. As sales keep increasing, the size of the business also of that particular product will keep increasing.
Thank you, sir. So what percentage of the company would be held by the promoters post listing?
So, sir, it will be about close to 52%. See, our current promoter holding is about 57.5%. It would come down to about 52%.
Thank you. So your gross margins pre-pandemic were about 60%, while FY21 and Q1 of FY22, the gross margins were about at 56 to 58%. So what are the steady state gross margins, and will it improve as EBO proportion increases?
Yes, sir. So see, this 57, 56, 57%, sir, was a lot to do because of the raw material prices increasing a little bit in the last few months. So we feel now in the coming months to come, these gross margins will settle down to what our gross margin was pre-pandemic. And steady state, as the EBO mix keeps increasing, rightly you said, the gross margins at a company level will keep improving more than 60%.
Thank you so much, sir. Coming to the next question, based on the recently reported Q2 FY22 numbers for most apparel companies, we see that there's been a growth over the pre-COVID base for most of them. How was the first half of FY22 or Q2 FY22 for us? And do you also think that this strong recovery for most apparel brands is due to some pent-up demand?
So Q2 has been very good for the retail industry. And as well it's been for the retail industry, it's worked well for us as well. And yes, in the initial weeks, we did see a lot of pent-up demand. But post the pent-up demand, we have seen the demand stabilizing and coming back to pre-pandemic levels to a large extent. So as it's been good for the entire retail industry, it's been very good for us as well.
Thank you. Thank you so much, sir. Could you also please help us with the working capital metrics for the company?
Sure, sir. So our working capital days is about 150 days as on fiscal year 20. We feel the 150 days is predominantly 100 days of inventory days, and receivable days is about 50 days. Our ideally we would want to keep our inventory days from 100 days to 90 and bring down our receivable days from 50 to 30. So in the near future, in the years to come, we are looking to bring our working capital days, which is currently at 150. We would like to bring it at 120. But currently, as on fiscal year 20, we had working capital days of 150 days.
Thank you. And so currently, how many suppliers would we have, and what are your future plans?
So sir, we have about close to 70 suppliers across fabric, across job workers. See, majority of the volumes do come from the top 5 or the top 10 suppliers. But we as a principal want to keep adding new suppliers because we want to grow our supplier network. When we add a new supplier, it takes a decent amount of time for that supplier to settle down and match the expectations, what we expect out of them. So our idea is to have a large supplier base so that as the company grows in the years to come, sourcing and outsourcing model is not a challenge for us. So we have a dedicated sourcing team who takes care of us.
Thank you, sir. Sir, do you have any scope to increase the prices of your core products, and how many have you done in the last, 3 to 5 years?
Yeah, sir. So, sir, see, there are two things here. Our average selling price has definitely increased, but there are the major reason for the increase in average selling price is because the newer products, what we are introducing, are slightly of a higher selling price. Otherwise, for our existing products, we would have taken a price hike only about 2 to 3 times in the last 10 years. See, we as a company at Go Colors, we believe in right pricing. Right pricing means reaching out to all the customers in the country across all geographies. Today, we don't want to overcharge the customer. So for our existing product, we only increase when there is a long-term increase in raw material prices, which we have increased about 2 to 3 times in the last 10 years. But having said that, in the years to come, as we keep adding new and new products of a slightly higher selling price, our average selling price also will keep increasing to that tune.
Thank you, sir. So coming to the next question, what market share are you targeting in the next 2 to 3 years? And what is the debt equity mix currently?
So, sir, see, currently we don't have any debt because of our very good working capital cycle. And even in the years to come, the way we are building a direct to consumer brand, cash flow from operations will be very strong. So we feel debt will not really happen in the future because of the way our business cycle is. As far as sorry, what was your first question? Your market share, you said. Okay. So as far as market share is concerned, see, currently we are at about 8% market share out of the branded market. We have grown at CAGR of more than 30% in the previous years prior to the pandemic, and we are going to have healthy growth rates in the future and slowly increase our market shares in the years to come.
Thank you, sir. And so, would you be seeding more brands in the future to reduce the risk of having one master brand? Like TCNS has built 2 to 3 brands over time.
See, currently, sir, the way we have designed our pricing strategy, the right pricing, there's actually no need for us to have a different brand in bottom wear category. This one master Go Colors brand can go to from tier 1 to tier 5 without any problem, without any constraint. So as of now, the way nicely we have priced our product, we really don't see a need of having a secondary or a third brand.
Thank you. And sir, could you throw some light on why the receivable days are a little high, given the fact that 70% of the business is B2C?
Sure, sir. So, sir, see, the receivables what we are having is coming from 30% of the business. Very rightly you asked. Because our terms with large format stores are as such, they pay us only after they sell forward. They basically have it on SOR basis. So the inventory which is with the large format stores is receivables in my books because of accounting standards. So that is why the receivables is on the higher side. See, today if I take this 50 days of receivable days what I have, 35 days would be unsold inventory at the LFS store, and 15 days would be the real receivables of the business. So that is why the receivables are on the higher side, because our business with the large format stores is on a SOR basis.
Thank you, sir. And so, what is the current credit period that we offer to large format stores? Will we eventually not be present at large format stores, or just focus on the EBO stores and online?
So see, the question is twofold here. See, we are LFS is a very, very important channel for us because it gives us visibility to the customers of the large format stores. It gives entry into new geographies before we have opened our EBO in those geographies. So large format store is a very, very important channel for us, which we are going to grow. But having said that, our direct to consumer channel, which is our EBO channel, is going to grow fast at a faster speed than the large format store channel. So yes, our presence, we are always going to be there in large format stores, but our major focus is going to be on EBO in the years to come.
Thank you, sir. So you mentioned that pricing is critical over here. In inflationary RM scenario, are you able to pass on the RM price increases? Also, on average, what kind of price increases have you taken?
So just like I explained, we usually, so there are two types of price fluctuations. One type of price fluctuation is long-term price fluctuations, and one is short-term fluctuations. See, because of our healthy gross margins, whenever there are short-term raw material fluctuations, we usually don't increase the prices, because we, like I had mentioned, the pricing is a very, very important aspect here. But when there are long-term pricing fluctuations, and in that kind of a situation, we have increased the product, the selling price of our current products. In the last 10 years, there would be 3 such instances when we have done that. So here, we are very, very careful on what pricing we want to sell. But having said that, our average selling price will keep improving because of the new product introduction, which is of the slightly higher selling price.
Thank you so much, sir. So could you also please throw some more light on the EBO store economics?
Sure, sir. So, sir, see, we are able to generate a EBO channel profitability of 30% Ebitda. Our capex involved is about 18 lakhs. And our sales per square feet is one of the highest in the industry. Our EBO typically matures within about 15 months. About 15 months it matures. And in our case, our mature stores have better sales per square feet even compared to our newer stores. So this strong EBO economics of low capex and high Ebitda has resulted in us to open so many stores in the last few years.
Thank you so much, sir. Sir, coming to the next question, you have a revenue of around 368 crores at an issue price that you're asking for a valuation of about 10 times revenue. As per the listing price, the company would be valued at 69 EPS. So how much money is being invested to increase capacity? And if you could throw some light on the EPS part of it, please.
So sir, we are currently we are getting a primary infusion about 125 crores in the company, which is we have done our calculation and we feel to add another 120 EBOs over and above what we had planned. We would require 120 crores. So this 120 crores is going to be a combination of the new 125 crores is going to be a combination of the new 120 stores capex at deposits and also for working capital. About 61 crores out of the 125 crores will be going for working capital and the balance will be general corpus. So this is the 125 is going to be funded in the company to expand to support the future expansion model.
Thank you so much, sir. Sir, coming to the next question, could you please talk about some more historic numbers in terms of the revenue, EBITDA, and PAT, if possible?
Sure, sir. So in fiscal year 19, we had a revenue of about 282 crores, with a PAT of 30 crores. In fiscal year 20, our revenue grew to 392 over a CAGR of more than 30%. And our PAT also grew at a CAGR of more than 50%. We delivered a PAT of about 52 crores. This 52 crores and this 392 crores, because of the pandemic, we took a hit. So this 392 crores fell down to about 250 crores in fiscal year 21, where we had a 3.5 crore loss in fiscal year 21 because of the pandemic.
Thank you so much, sir. Sir, could you also throw some more light on why do Go Colors have over about 700 SKUs while other brands have much less in number? And how do you manage to deal with the kind of SKUs that you have?
Sure, sir. So, sir, we as a brand, one of our key important aspects is range, colors, and products. If today we don't give the range of 100 colors or 120 colors, or don't give the product range of 50 products to the customer, the top end of the colors will not sell. The range, the variety, the depth is very important. So because of that, though our product is core, it's evergreen, but our product has a lot of SKUs because of the number of colors. So this range, this variety, this SKU mix is very, very important for the top end of the colors to sell well.
Thank you, sir. And sir, given the recent increases in input costs such as yarn and fabric, have you been able to pass on the increased cost to consumers?
So sir, we had recently increased in some raw material pricing, but we have increased some prices of our finished goods as well. But it's not really impacted us to a very large extent. The little bit what happened, we had increased a little bit pricing in some of our products.
Thank you, sir. Sir, could you also throw some more light on the revenue mix between core leggings and the other bottom wear that you have? And could you also tell us some more about your views on international expansion?
Sure, sir. So, sir, our core leggings and chudidars contribute about half of the business, and the balance half of the business comes from our other value-added products. It is a very good blend. This was a blend. If I take in the beginning years of the company, or maybe even 5 years back, more than 70 to 80% of the business was coming from chudidars and leggings. Today, we have not only seen an increase in volumes of sale from chudidar leggings, but our mix surprisingly has increased for the other products as well. So we are seeing a half and half ratio between our chudidar legging, core chudidar leggings, and our other core value-added products. And on the international expansion, currently we are very well focused in India. We feel India is a very large country. India is a growing country. India is the next growth story. We have right now, just at the tip of the iceberg, we have 60% of our EBOs comes from the top 8 cities. So there are many cities we have to go to as far as tier 2, tier 3, tier 4, and tier 5 is concerned. where we already have presence through a large format stores. So we see the big growth story in India. So because of that, we feel that we want to stay razor sharp focused on bottom wear and want to stay razor sharp focused on India as a strategy.
Thank you, sir. And sir, do you believe there's any seasonality in your business? And if there is, then is there any particular month that you see any disproportionate sales?
So sir, there are two aspects. One is selling period and one is product. From a product perspective, we don't have any seasonality because our product does not go out of fashion. But as far as the year is concerned, the 12 months of the year is concerned, the festive period is usually the best quarter of the year. The first quarter of the best quarter of the year. The first quarter, which is April, May, June, also is a very good quarter. Quarter 2 and quarter 4 are slightly lean. But for us as a product, because ours is a day-to-day product, the delta difference between each quarter is not so much. Having said that, quarter 3 usually has a better spike compared to the other quarters.
Thank you so much, sir. Sir, could you also throw some more light on the product pricing? How to decide the pricing for different regions?
So, sir, we have a very straightforward pricing strategy. Today, our pricing, whether you buy us at a LFS or whether you buy us at a EBO, online or any part of the country, you will find us, the pricing is very, very, very consistent. So what we do is, whenever we are introducing a product, first we do market research and study at what price we can sell our product and customers will be able to buy it or not able to buy it. Like I said, the right pricing strategy. After we know what our selling price is, then we calculate and see what our cost of goods sold is. And then see whether it is worth introducing that product or not from a commercial perspective. So our main focus is backward calculation from the selling price rather than forward calculation. So we always first see what the market price is and what competitive price we can sell at, then study what is the cost of goods sold, and then decide whether we can introduce that product or not.
Thank you, sir. Sir, coming to the next question, what change have you made on the operating front that the Ebitda margins have improved from 16 to 18% in 2018 and to 33% in 2020?
Sure, sir. I'll tell you an idea, or I'll tell you a perspective. We had implemented Ind AS 116 in fiscal year 20. So what happens in Ind AS 116 is your rent is capitalized and shown as interest and depreciation. So today, our actual Ebitda, which is showing at 32%, if you see in the financials, is actually 21%, 21.5%. So the improvement in the Ebitda is from 16 to 21.5. The 32 is because of Ind AS 116 accounting standards. We had to capitalize the rent and show it as depreciation and interest.
Thank you, sir. So also out of your 450 stores, around 250 plus stores are present in top 2 metros and in the top 6 cities. What kind of growth do you see from Tier 1 and Tier 2 cities?
So, sir, see, Tier 1, Tier 2 city is growing at a very fast speed. I'll tell you and I'll give you an example. I'll give you an analogy. If you take Bangalore, today, 5 years back, if I had to do and see how many stores I can open in Bangalore versus today, there is a very big difference because Bangalore as a city is growing. The same thing is with other metro cities and other Tier 2 cities. As the years go by, the potential of the number of stores I can have in a Tier 1 city will keep increasing. And that is the same case with Tier 2, Tier 3 and Tier 4 as well. So a good portion of our stores would be coming from our existing Tier 1 and Tier 2 cities.
Thank you, sir. So we'll be taking the last couple of questions for this evening session. Coming to the next question. What has your approach been on the discount and end of season sales?
So, sir, see, we are very thoughtful about discount. And I'll tell you, it's not that we as a company don't want to do discount. Our category is as such where discounts are not required because ours is a core essential wear category. It's a day-to-day product. It's a round-the-year product. It's a core category, and core category usually does not have discounting. More than 97% of our sales comes on full price. So that is an advantage and benefit of being in a core category like this, where the inventory is evergreen and the pricing is full price. So which is a good pillar and asset for us. But having said that, in some few cases, we have done some promotions during festive times, so which has worked very well for us. But like I said, that comes in the last 3% of the business. More than around 97% of our thing comes from full price.
Thank you, sir. Sir, coming to the next question. If maximum of your receivables is from large stores, how do you plan to reduce your receivables from 50 to 30 days? And are the large format stores going to keep less inventory?
No, sir. So I'll tell you how it happens. So the absolute number of the receivables will not change. What happens is, as your EBO sales increases, your percentage of LFS sales as a percentage of total revenue will come down. So when that happens, organically and automatically, this 50 days will come down to 30 days. So the receivables really will not change. It's just that the EBO mix will compensate and bring down the receivable days from 50 to 30 days.
Thank you, sir. Sir, and how have your e-commerce and digital sales grown in terms of percentage over the last couple of years?
So, sir, see, pre-pandemic, our online sales were very minuscule. We had about a couple of percentages of about 1.5% of online sales. Post-pandemic, we have seen a big surge. We have seen an 82% increase in our sales. This 1.5% has gone up to 5%. And we are seeing very, very strong growth in our online business even in the years to come because we are implementing an omni-channel strategy.
Thank you, sir. Sir, could you please talk a little bit more about your product sourcing operations and about the time taken from concept to launch? And how has this time been historically for you?
So, sir, see, it usually when we develop a product, when we're introducing a product, it takes about 3 or 4 months for us to do research, to check what kind of product we want. We do our market research on pricing, fit, availability, color. Once we think about a product, we source it in small quantities and place it in some of the stores across the country. Now, what our ERP and backend technology does is it monitors the SKU at a sales level on a daily basis, on a real-time basis. So as the sales of the products keeps increasing, my backend sourcing and stocking also will automatically increase. I don't, because of my strength in technology and data analytics, I don't have to introduce too much of quantity in a new product altogether. I can test it with short quantities, and over a period of time, as the sales of the product keeps maturing, the stocking also will keep increasing. So for any new product to come in and settle down, it takes about a few months till we launch it, and then another few months for us to understand the trend.
Thank you, sir. So also, what is the trend of shrinkage as a percentage of revenues and the policy around inventory write-offs?
Sure, sir. So, sir, shrinkage at our stores is very, very minuscule because of our very strong operational control. It has been very, very negligible shrinkage because we have very, very strong inventory control policies across our warehouse and across all our stores. We do third-party audits. We do internal audits. So there's a lot of checks and measures as far as inventory and shrinkage is concerned. But as far as provisioning is concerned, we do provision inventory which is greater than 365 days old on a COGS basis. We write down the inventory by 70% every year. Though our product is evergreen and it's non-seasonal, but as a company, to be on the conservative side, we have an inventory provisioning policy in place where any inventory which is greater than 365 days old on a COGS basis, we reduce the value of the goods by 70%.
Thank you, sir. Sir, as you said, you're implementing on an omni-channel based. So wouldn't your operating costs increase over here?
Not really, sir. See, actually, because we are doing last mile delivery, what I would be, see, the logistic cost in online business is always on the higher side. But why it's not high for us is because ours is a very standardized core product, there are not too many returns from customers. So our logistic cost has always been on the lower side. In fact, my logistic cost will reduce. I'll tell you why. In my online business, I'm going to be dispatching it from my warehouse. Here, because of my last mile delivery, where I'm going to be supplying it from my closest store to the customer, my transportation cost because of distance should actually come down. So in fact, this omni-channel is going to reduce my cost, not increase it.
Thank you so much, sir. So we're taking the last question for this evening session. Could you also talk more about your expansion plans into other ethnic wear? Would that be a focus?
Not really, sir. Our focus right now is, like I mentioned, razor sharp focus on bottom wear and sticking to India's growth story, and keeping bottom wear as a category. So right now we are not really looking at other categories right now, because bottom wear itself is very big.
Thank you, sir. And sorry, how many stores fall in the mature store category and have revenues of 75 lakhs per annum?
So, sir, about 300 stores out of the 459 would fall in the mature store category.
Thank you so much, sir. With that, we come to the end of the Q&A session. While we have tried to answer majority of the questions, we are aware that a couple of questions have remained unanswered. So I'll be sharing an email ID with you before the close of this evening session, which you could write back to us, and we'll ensure that we revert to all your queries. I would now like to call upon Mr. Saurabh Jain from ICICI Securities Limited to give the vote of thanks. Over to you, Mr. Jain.
Sure. Thanks, Nikhil. Thank you, Gautam, for taking us through this presentation and the key highlights of the issue. Given the strong positioning of the company, we hope that this issue will receive a blockbuster response from the investors. GoColors clearly is India's leading women's bottom wear brand and the first company to launch exclusively dedicated brand for the women's category, bottom wear category. The company has leveraged this advantage to create a strong D2C brand with a diversified and differentiated product portfolio and at a competitive prices, which we believe will position the company very strongly in the minds of the investors. I would like to thank you all for attending this virtual meet and sharing your thoughts with us. We look forward to your support for making this issue a huge success. Just to summarize on the issue, the IPO consists of primary issuance of 125 crores and offer for sale of roughly 1.28 crores. Aggregating up to 1,014 crores at the upper end of the price band. The price band is around 655 to 690 rupees per share at the face value of share of rupees 10 each. The IPO opens for subscription on 17th November and closes on 22nd November. Thank you, everyone.
Thank you so much, sir. I would like to once again thanks everyone for joining the virtual brokers and analysts meet of Go Fashion India Limited for the forthcoming public issue. Please feel free to reach out to us for any further queries. You could email us at hello@gocolors.com, and we'll definitely do our best to revert to all your queries within the next 48 hours. We look forward to your wholehearted support in making this IPO a grand success. Thank you all once again. Take care and stay safe. Thank you.
Thank you, everyone.
Thank you.